So the market's been giving us all a bit of a roller coaster lately, haven't it?
Yeah, it really has a lot of chop.
And, when things get bumpy like this, it's pretty natural to start looking for investments that maybe offer a bit more stability and maybe a reliable income stream.
Exactly. That search for steadiness often leads people towards dividend stocks. They become really appealing in uncertain times.
Right. So that's why we're taking a deep dive today into, well, the world of dividend-paying stocks. We've pulled together some notes, some research. Let's just call it our source material for today. And our mission really is to explore why building a portfolio around dividend stocks,
Yeah.
particularly those that consistently grow their payouts,
Oh.
why that can be such a smart long-term strategy.
Yeah, for both, sort of smoothing out the ride and generating that passive income.
Okay, so starting point. It's crucial, isn't it, to get this core principle right?
Absolutely. Investing in dividends,
Yeah.
it's not primarily about chasing the absolute highest yield you can find right now.
That can be a trap, yeah. A yield trap.
It really can. While a big upfront percentage looks tempting, the real power, the real goal here is long-term total return. It's definitely not a get-rich-quick kind of thing.
So it's more about the long game.
Precisely. The focus really needs to be on finding those companies that consistently and significantly increase the amount they pay out each year.
Okay, so not just paying a dividend, but growing it, like substantially.
Yeah, we're talking, maybe 10% increases, sometimes even more year after year. That's really the engine driving this strategy.
Okay, let's dig into how that works then.
Okay.
It's tied to compounding, right? That famous snowball effect.
That's the core of it.
How does the growth part of the dividend make that snowball bigger faster?
Well, it creates this really nice positive cycle. So the company pays you a dividend, cash in your account.
Right.
You take that cash, hopefully, and reinvest it. Buy more shares of the same company. Now, here's the key. The company also keeps increasing its dividend payout per share over time. So you're not just getting a bigger payment on your original shares, but because you've been reinvesting, you now own more shares, and all of them are getting that higher growing payout.
So it feeds on itself.
Right.
Growing dividends, buying more shares, which earn more growing dividends.
Exactly. It's that continuous loop. Growing dividends plus more shares equals an ever-expanding stream of passive income. That's the magic.
Right. Okay. To make this less abstract, our source material gives some pretty concrete examples. Let's look at Broadcom, ticker AVGO.
Okay.
Now, its current yield is, what, around 1.3%? Which doesn't sound huge up front.
No, not on the surface.
And this is the point, right? Its dividend has grown by an average of 14% per year for the last 5 years.
Wow, 14% average growth. That's significant.
And they've increased that dividend for 14 years straight. That kind of consistency. It says something, doesn't it?
It absolutely does. That combination, a strong growth rate plus a long streak of increases, often points to, well, a really healthy company and management that's committed to returning value to shareholders. It suggests confidence in the future.
Okay, next example. Home Depot HD. Current yield's a bit higher, maybe 2.6%, and their 5-year dividend growth rate is 10%. Plus, they've got a 15-year streak of increases.
Right, another solid example. You start seeing this pattern, don't you? Established companies, good track records.
Yeah. So what makes these specific kinds of companies good candidates generally?
Well, typically you're looking at businesses with a strong foundation. They generate consistent profits, reliable cash flow. Often they have some kind of competitive advantage, a moat in their market.
Which allows them to keep paying and growing those dividends.
Exactly. That financial stability is key. It lets them reward shareholders as the business itself grows.
Okay, then there's Nextero Energy, NAE. Yields about 3.5%, 5-year growth rate also 10%.
Solid numbers again.
But the really remarkable thing here is the streak. 29 consecutive years of dividend increases, almost 3 decades.
Yeah, that's impressive. 29 years.
What does a track record that long tell you?
Well, it strongly suggests a really resilient business model, something that can handle different economic ups and downs. And it also points to a management team that's clearly focused on the long-term shareholder value. That kind of history provides a lot of confidence for an investor.
Okay, moving on. Tractor Supply Company, TSCO. Yield is 1.8%, so similar ballpark to Broadcom initially.
Right.
But look at this 5-year dividend growth rate.
Right.
26%.
Wow, okay, 26%. That's
Yeah.
really high growth.
Yeah. And they've also got a 14-year streak of increases. That growth rate definitely catches your eye. How important is a rate like that?
A growth rate that high can dramatically accelerate that compounding effect we talked about.
Okay.
Even starting with a lower yield, if you can sustain or if the company sustains that kind of growth, your income can really balloon over time.
But is it sustainable? 26% a year.
That's the question, isn't it? You'd want to dig in and understand why it's growing so fast and whether that's likely to continue long term. High growth is great, but sustainability matters too.
Good point. Okay, last one on the list. Devon Energy, DVN. Current yield is higher, 4.2%.
Okay, getting more income up front.
And the 5-year dividend growth rate is also high, 25%. But the streak is shorter, 7 years.
Right. 7 years is still decent, but it's not the decades we saw with NextEra.
So how do you weigh that? A higher current yield versus maybe a shorter track record of increases?
Yeah, that's a classic trade-off you often encounter. The higher yield gives you more income now, but the shorter history. Well, it might mean a little more uncertainty about future growth compared to a company with, say, 20 or 30 years of hikes.
So it depends on your goals. Maybe someone closer to retirement wants the higher current yield.
Potentially, yes. Or maybe you blend them. Ideally, you find that sweet spot. Reasonable yield, strong growth, long history. But sometimes you have to balance those factors based on your own situation and your risk tolerance.
Okay, that makes sense. Now, to really kind of picture the potential here, our source material lays out a few scenarios. Hypothetical, of course.
Sure, examples help illustrate the concept.
Right. So, scenario 1. Start with $20,000. Add $1,000 every month. Assume the portfolio has an initial yield of 3%, and this is key, an annual dividend growth rate of 12%.
Okay, so consistent investment, decent yield, strong growth assumption.
Yeah. After 10 years, the projection shows that portfolio potentially generating around $8,700 in annual dividend income.
Okay, $8,700 a year after 10 years. Not bad.
But then, fast forward, after 20 years, projected $48,000 a year.
Wow. See, that's the compounding really kicking in between year 10 and 20.
Exactly. And after 25 years, it could be over $115,000 in annual dividend income.
$115,000 a year from dividends alone. That's a powerful illustration of the long-term potential.
It really is. It shows how passive income can really build over time.
And what really stands out is that exponential curve, It starts slow, but then it really ramps up, especially with those regular contributions feeding the fire alongside the reinvested dividends and the dividend growth.
It highlights that the starting yield, that 3%, is just, well, the starting point.
Absolutely, just the seed.
Scenario 2. Starts with more capital, $50,000.
Yeah.
And invest $1,500 monthly. The initial yield assumption is slightly lower, 2.5%, but the dividend growth is still assumed at 12% annually.
Okay, bigger starting pie, bigger monthly additions.
After 15 years this time, the projected annual dividend income is $28,000. And after 25 years, it climbs to potentially $135,000 per year.
So again, a really substantial income stream builds up over that longer time frame. What does this one tell us comparing it to the first?
Well, it seems to show how having that larger initial sum, the 50K instead of 20K, can kind of jumpstart the process, right?
Yeah, exactly. It gives compounding a bigger base to work from right at the beginning. The monthly additions are still super important, but that initial lump sum definitely accelerates things.
Okay, last scenario. This one starts with $100,000 and adds $2,500 monthly. Again, 2.5% initial yield, 12% annual dividend growth assumed.
All right, bigger numbers all around.
After 20 years, the projected annual income is around $110,000.
$110K after 20 years.
And after 25 years, it could reach a very impressive $235,000 per year.
Wow, okay. $235,000 a year in passive dividend income.
Now, obviously, these are hypotheticals. Assumptions are made. The market doesn't move in straight lines.
Of course. Real-world results will vary, but the principle they illustrate is powerful.
That's the key takeaway, isn't it?
It is. The underlying message is that a consistent focus on quality companies growing their dividends combined with reinvestment and time, while it has the potential to generate really significant passive income. It's about steady building, not market timing.
So boiling it all down then, based on this deep dive, what are the absolute must-haves, the key pillars for successful dividend growth investing?
Okay, pillar number 1, I'd say, is selectivity. You have to invest in fundamentally solid companies, meaning businesses with a track record of profits, ones that generate healthy, reliable cash flow. Ideally, they have some sort of competitive advantage, like we mentioned.
Because those are the ones most likely to keep paying and growing the dividend.
Exactly. They need the financial strength to do it. Pillar 2 is the discipline of reinvesting those dividends consistently.
Don't just take the cash and spend it necessarily. Put it back to work.
Right. That's what really fuels the compounding engine, buying more shares with the dividends. Those shares then earn more dividends. That's the snowball effect in action. It's crucial.
Okay, so solid companies, reinvesting dividends.
Right.
What's the third pillar?
The third one sounds simple, but it's often the hardest. Patience. You just have to give it time.
Let compounding do its thing.
Precisely. This isn't a get-rich-quick strategy. We said that before. It takes years, often decades, for those steady increases and the reinvestment to really build up into a substantial income stream. You have to play the long game.
Yeah, delayed gratification, which isn't always easy in today's world.
It really isn't.
Yeah.
But it's essential here.
And one thing that I found really encouraging from the source material, you don't need to already be wealthy to start this.
No, absolutely not. That's a critical point.
You don't need like $1 million portfolio on day one.
Not at all. The key is commitment to the strategy and consistency. Even starting small, with modest initial amounts and regular contributions, if you stick with it, reinvest dividends from quality growers, you can achieve really meaningful results over the long haul.
So it's accessible. It's about starting wherever you are and just being consistent month after month, year after year.
That's the core message. Consistency and time are your best allies.
So that brings us back to a question that was actually posed in our source material, and it's a good one for everyone listening to think about. What is your passive income goal?
Yeah, it's a really powerful question to ask yourself. What level of income not directly tied to your day job would actually make a difference to your financial security, your freedom, maybe your retirement plans?
Really thinking about what that number looks like, and then maybe seeing how a strategy like this could, over time, help you get there.
Exactly. It helps put the long-term effort into perspective.
Ultimately, building a really meaningful passive income stream, whether it's through dividend investing or other means, it's a journey, isn't it?
It absolutely is.
A journey of, like you said, consistent effort, strategic choices, patience, all playing out over time.
It's about planting those seeds now, nurturing them through reinvestment and compounding, and letting them grow into something significant for your financial future.
Definitely something worth mulling over as you think about your own long-term financial picture.